Good afternoon, everyone. I am NPHD Co-President Wakatsuki. Thank you very much for your attendance today. Allow me to explain the progress of the 2021-2023 midterm business plan. Thank you. I will discuss summary first. In a nutshell, the environment has changed radically since the midterm plan was formulated in March 2021. However, as we approach to the end of the second year, final year, I think we can say that we have reaffirmed the resilience of our model. Following on from last March today, again, let me explain on our robust MSV model that we pursue. First of all, strong demand in markets of all group companies, ability to pass on cost under this particular environment can only enable us to expand further our market share. There are various events taking place on the ground, including supply chain disruptions. By not headquarters driven, but by letting able management on site to make decisions in an agile manner, risks are turned into opportunities. We've seen that capability in place. The model of accumulating quality assets through M&A with low funding raising cost has contributed significantly to EPS growth, starting with DGL and BETEC in 2019, followed by the full integration of Asian joint venture and Indonesian acquisition in 2021, and Cromology and Yub in 2022. I believe that our M&A model is one that allows us to maximize the potential of a target quality acquiree. In particular, each of our assets is highly cash generative and does not require additional capital investment, basically, for example, in Turkey, which is currently experiencing very high inflation. In China, where geopolitical risks are mentioned by many, but in principle, cash is generated, and dividends continue to be paid to holdings with investment in growth within the region. We feel that the so-called decoupled model, which is also local production for local consumption and based on a high local market share and profitability, can only show its true value in this difficult environment. In addition, without unnecessary interference with the head office and encouraging autonomous collaboration between partner companies, since last year, holdings has become very lean. We were able to lay the foundations for a true asset assembler that can continue to expand in the future. And this is also a question many investors ask about how we view this risk in this rising interest rate environment. We believe that we have the opportunity to demonstrate our superiority by continuing to finance in yen terms and maintaining strong relationship with Japanese banks. It has been 2 years since I became co-president with Mr. Ryosuke. The frequency of mutual visit increased by moving away from online-based meeting under COVID-19 situation, and that helps us establish closer communication. At the end of March, all directors gathered for the general meeting of shareholders, where an intensive discussion on strategy, including the progress of a midterm plan. As we continue to make MSV our sole mission, we would like to fulfill your expectations. While today we report on the progress, that is page 5 of the midterm plan, there is basically nothing new in terms of figures, as the guidance for the final year was already given in February. The section presents a comparative analysis of the assumptions made in 2021 and the assumptions at the moment. Please look at the graph on the right. But note that these figures are only approximate so as to give you an idea. As for sales, back in 2021, our target for 2023 was 1.1 trillion yen, but now it is 1.4 trillion yen according to the current guidance. Of the 3 businesses sold to Woodram in 2021, in 2020, the decorative business in India, Nippon Paint India, was the equity method affiliate, and only the Indian and European automotive businesses were consolidated. Sales amounted to 772.6 billion yen, excluding these 2 businesses as discontinued operations. On the other hand, the 1.1 trillion target includes 3 businesses. According to the rough assumption back then, it would account for some 45 billion yen. Thus, if that amount was deducted, it would make an apple-to-apple comparison. The actual exchange rate in 2020 and the assumed exchange rate at the time of March 2021 are almost the same. Therefore, as to the organic-based figures originating from this point of time, excluding Turkey, it will be about 20 billion yen higher than the assumption, giving a real CAGR of about 12% from 2020. In 2021, the CAGR was set about 10% excluding India, but including Turkey. Compared with that, we could say that we have sufficiently outperformed. Adding to that, the impact of yen depreciation and effects of M&A over Cromology and Yub, and also significant impacts generated from the growth in Turkey in local currency are recognized, but negative impact of foreign exchange and also superinflationary accounting, IAS 29, are significant. With that, potential upside of some 35 billion yen is expected as an overall impact. Now the organic growth figure shows an increase of 20 billion yen when compared then and now. 1.1 trillion yen we set forth in 2021 was a straight figure, which was a little higher than the individually built-up number. Thus, in reality, it was the uptick by more than 20 billion yen, I should add. Operating profit, on the other hand, was affected by unexpectedly high raw materials price and the war in Ukraine. It is predicted to fall by 25 billion yen with a combined organic and divestment impact. However, recovery is made via foreign exchange and M&A. The impact of Turkey is positive in local currency, negative impact in forex, and also with the superinflationary accounting, resulting in a slight downward revision compared to the assumptions. From the overall perspective, even under this severe business environment, the company has achieved better than expected organic growth, while M&A has also contributed to the build-up. That steady growth is expected. Here too, we try to do a factual comparison of assumptions made back then and now. I won't go into detail, but as to the decorative market, while a very strong growth was recognized, even though not in a constant manner, there were issues in industrial business due to COVID-19 and supply chain disruptions. Market has suffered, I suppose. When it comes to the volume, we were able to expand solidly. Also, we did raise the unit price in response to the rise in raw materials. With regards to adjacencies, growth of DGL Sales and the acquisition of Vitaltech in Malaysia and the purchase of Yub that has strengthened EdTech have contributed more than our expectations. Now, as for the interest rate, as we fixed the rate, there were not much change. Having said this, given the increase in debt associated with M&A, the absolute amount has increased. The effective tax rate has also increased compared to the original plan, but net income and EPS level showed slightly fall, and there is a huge impact of IAS 29. The last part of summary describes an overview by region on page 7. The segments have been reclassified since 2022. It is retroactive up until 2021, but not before. Therefore, we hope you would gain understanding of the outline. In addition, FY21 results are on the tangent basis. For FY22, it is non-GAAP basis with a constant forex, but excluding M&A. In other words, Cromology and Yub are not in the scope. When looking at this slide, you see that the growth is expected that will outperform the initial forecast in most regions internally, especially China, Australia, Malaysia, and Turkey, where some factors are incorporated, exceeded the assumption. Meanwhile, in terms of profit, we believe that many regions have held up well. Japan and China are expected to fall short of expectations, though. This concludes the executive summary part. On page 9 and beyond, I will discuss briefly on each asset. With respect to the Chinese market, although the growth has been slow over the past few years against the backdrop of COVID-19 and the deterioration of property market, the view has not changed that the growth percentage of the market will be GDP plus alpha in mid to long term. In particular, as you find in the middle box, the property market has entered the stock housing era. It will sufficiently cover the sluggish new construction business, and we expect that paint consumption per capita will go up with the economic growth. Therefore, the key is how to achieve growth in both market share and profitability in this growing market. In this context, on page 10, the TUC market can fully take advantage of our growth, which has led to the share increase in 2022. We hope to leverage our brand power in those Tier 3 to 6 cities where our efforts were rather light in order to expand our share in lower-end price segment without fail. In TUB on page 11, on the other hand, our share of the overall market fell slightly as a result of the difficulties faced by key developers. We focus on reduction in business with non-cash on-delivery customers, but we presume that the same trend was observed in all the top companies as our peers and competitors. Down the road, we will develop more diversified customer portfolio to achieve both market share and profitability while leveling risks. In the mid to a long term, as this market still offers an opportunity for us to grab more market share from smaller competitors with a vast market size in place, we would like to keep focusing on this market. Please see page 35 of appendix. I will share the Nippon China first quarter preliminary result. All figures are represented in local currency and forex is not factored into, and consolidation adjustment have not been completed. Thus, this is just for your referential point. Year-on-year basis, decorative grew 13%. Of those, TUC grew 19%, TUB 4% growth. For auto business, overall market was sluggish, therefore it recognized double-digit decline on sales. China collectively grew about 8%. As for margin, that's a key. On a flash report basis, year-on-year and period-over-period, an improvement of more than 2 points are expected. The details of that will be explained at the earnings guidance in May. Apologies as this is a little bit half-baked information, but with respect to the improvement status in China, I have said it would depend on the result in March, but this information shared as a flash report exceptionally. For your information, other regions' results vary on a preliminary basis. Some region has been affected by climate, others still face hovering high raw material price impact. Not all are recovering consistently. Having said this, we feel it shows a positive movement. Please go to page 12. Go back to page 12. Next is Beteboya in Turkey. It is an extremely volatile market. In short time, the earthquake had a negative impact on domestic GDP, and although it did not affect our workforce and factories, it cast a shadow over consumer confidence. However, since there is a solid demand with a population of 80 million, we have no concerns from mid to long-term perspective. After the presidential election, a shift in monetary policy and turnaround in consumer confidence are expected.
Page 13, Indonesia. There is not much updates on Indonesia since I explained about the region in the past. There are uncertainties such as the presidential election scheduled in the beginning of 2024. We believe we can drive steady growth by focusing on driving our premium products and proactive execution of sales promotion. Page 14, DGL Group began its management broadly on two segments. Pacific segment focusing on Australia and New Zealand, and European segment focusing on Chromology and UB. Both segments are what we call the mature markets. Share growth is the only way to win in a market that does not grow in itself. Not much change is observed in the volume-based share as shown on this page, but the value-based share is growing accordingly, which is attributable to our focus on premium brands in the Pacific segment. Last but not the least, page 15, the Japan segment. Japan segment used to be a highly profitable segment as shown here. Instead of simply saving cost, adopting LFG or lean for growth approach that prompts growth while eliminating waste as quickly as possible throughout Japan will lead to recovering profit growth. Challenging environment continues, such as current elevated raw material costs, which is taking longer than expected to come down, but we believe that the Japan segment can grow steadily in a mature market in the mid to long term like DGL by enhancing efficiency and taking appropriate pricing actions. This concludes my presentation on each of the assets. 17 page on, allow me to update you on the sustainability strategy. We discussed and resolved to establish a basic policy on sustainability at the board meeting that was held recently. The new basic policy on sustainability replaces the ESG statement, which was the former sustainability structure. As I've explained in the past, it clearly states that MSV is the goal of our sustainability initiatives. It is based on asset assembler model. The new model does not make decisions in a centralized manner. Page 18. Again, as has been explained earlier, we evolved into a business-driven and site-driven autonomous sustainability structure from the top-down approach we used to have before 2021. Each leader appointed from different business functions coordinates the team activities from a very proactive and global perspective and reports the progress and proposals to the co-presidents every quarter. Pages 19 to 24 explains endeavors of each team. As what is required from the society and the extent of each requirement changes on an ongoing basis in all likelihood, we would like to fulfill our responsibilities, which is the assumption of MSV and is linked directly with MSV as we carefully watch the general trend in the requirements. I will refrain from going into the details of each activities. We jump to page 25. Due to our progress in sustainability and disclosure enhancement, we have been included in all of the ESG indexes adopted by GPIF and showed improvement in ESG rating scores. Page 27. M&A strategy will be explained from this page. There isn't any major change in our approach. We will continue to plan everything with the goal to achieve MSV, including the target, strength of our company, and financial discipline. Let us once and for all, on page 28, reflect momentarily on the case of DGL, which embodies the success of our company's asset assembler model. DGL was originally a spin-off from Orica, which used to be former ICI Australia. After the spin-off in 2010, DGL was listed as an independent company on the Australian exchange and was steadily growing in a mature market. In 2019, our company acquired this highly dependable company for 3.76 billion Australian dollars. Back then, the company was led by an excellent management team headed by Pat Houlihan, who took office as a CEO in 2007 and serves in the same role to this day. Page 29. When the deal was closed after the acquisition, Pat Houlihan asked Chairman Go of our company, "What would you like us to do now that we became a partner of your group?" in a one-on-one meeting. Chairman Go replied, "Pat, what we want you to do is not the point. The most important thing is what you would like to do and why you would like to do so. If what you want to do will lead to MSV, and Holdings will support your endeavors to the best of our ability. This is exactly a trust-based approach that respects autonomy." In response to this approach, DGL repositioned its strategy and adopted the three key strategic pillars shown in the left side of the slide. In other words, by extending leading position in the existing market, leveraging capability in the European market, and by expanding adjacencies business including SAF, DGL became capable of contributing about a quarter of our group company's sales revenue and operating profit as a result. This was enabled by executing 23 mergers and acquisitions in a matter of just 3 years right after joining our group. A major transformation from the time when only 9 mergers and acquisitions took place in 9 years at the time DGL was listed as an independent company. This case was an example of a company reaching its full potential as it no longer has to be concerned about the short-term changes in share prices at the time of listing, yet on the other hand being able to leverage the financing ability of a stronger platform. SAF products enhancement was a secondary effect of DGL acquisition, sealant, adhesive, and fillers, SAF stands for. Acquisition of Betek brought along ethics business. We also have CC, which expands the possibility of further adjacencies business growth. We plan to build up assets which contribute to EPS growth while controlling risks through such excellent mergers and acquisitions. Page 32, there isn't any changes in the financial strategy in principle. We are communicating closely with the financial institutions and rating companies so that leverage is set at an appropriate level. Occasionally, we are asked whether we will execute share buyback or not. At this point, our priority is to execute growth investment focusing on M&A, from which we can expect a higher return in terms of capital allocation. It does not mean that share buyback will never happen, but the priority is lower. Dividend payout ratio of 30% will be maintained in principle. Page 33. So we expect leverage or net debt EBITDA to decrease to around 2.9 times in 2023, which is the final year of the MTP, assuming that there isn't any additional M&A. As for capital allocation, the gap between the MTP guidance and the current guidance is 220 billion yen over the 3 years. Breakdown is operating cash flow being 30 billion yen below MTP guidance, capex and dividend largely in line with the MTP guidance, and M&A 190 billion yen excluding the acquisition in Indonesia. This is the final page that summarizes this presentation. We have already begun developing the next MTP. While individual assets are constantly updating asset level plans for the next 4 years on a rolling basis, how we design a consolidated basis MTP based on an asset assembler model is under discussion. We welcome investors' input and feedback to help us with the design. This is all for me. Thank you for your kind attention.